Thank you, Santia, so much for the kind introduction. And thanks, everybody, for joining the panel this afternoon. The topic is investing in a downturn. And as Santia mentioned, we have three very prominent private equity firms joining us. We have Kian Cotter from Insight Partners, Lindsay King from Crestview Capital, from Crestview Partners, and then Tracy Harris from Cirrus Capital. And so before we kick off, maybe I'll just ask our panelists to briefly introduce themselves and their firms.
Yeah, hi, Kian Cotter, Insight Partners. We're a New York City-based growth equity firm focused on the software industry.
I'll jump in. I'm Lindsay King. I'm partner and head of investor relations at Crestview Partners. We are also New York City-based, value-oriented middle market firm within all-weather strategy.
Hey, everybody. Really happy to be here. And thanks, David, for leading us through this. And thanks to RFK for hosting this great event. Who enjoyed some of the sessions I've seen to date. Tracy Harris. I'm a partner with Cirrus Capital, leading investor relations and product strategy. Cirrus is a value-oriented buyout firm. We focus on technology and telecommunications. We got $6 billion in assets under management, and we are headquartered in New York City. Happy to be here.
Great, thanks so much, Tracy. And I think when we think about investing in a downturn, there are kind of three themes or topics we'd like to cover. One is the macroeconomic environment, and then secondly, the investing environment for these three firms, and then finally, the investor relationship between the GP and the LP. But I think the macro environment is where we'll start, because before we talk about investing, I think with what we've experienced in this year in terms of economic dislocation, the pandemic, social inequality, I think it's important to understand how is this downturn or this cycle different from either the global financial crisis or prior cycles. And Kian, maybe I'll ask you to address that for us.
Yeah, thanks, David. Look, I think from my perspective, it's quite different in many ways, and it's quite similar in many ways. Certainly, if I compare it to the 2008-2009 period. But as we were preparing for this last week, I think one of the things that struck me was we also had our annual meeting last week with our investors, and as we were preparing for that, we sort of had to check ourselves, because when we looked at the news that we were delivering to our investors, and we looked at just our overall outlook, the performance in our funds, how our companies were doing, how the firm in general was doing, it just feels like completely disconnected from what we're seeing in the wider economy and in the wider community. And we really sort of had to check ourselves and put a preface on our meeting and sort of a preview, and sort of say, look, you're going to hear a lot of good news today, but that doesn't mean we're not tone deaf to a lot of the challenges that are happening out there in the broader economy. And it really sort of struck us, number one, how fortunate we are to be in the industry that we are, but number two, how somehow disconnected the financial markets and the capital markets have come really from the broader prosperity of our communities and of people in the economy. If you look at the S&P 500, it's up from last year. It's up from the start of the year, despite the fact that a lot of companies have downgraded their forecasts, specifically in our own sector in technology. We're at all-time highs from a valuation perspective. We're all-time highs in terms of activity in our space. Companies go public, companies are getting bought. We're investing in companies, and it's really hard to sort of look at that and sort of say, how is that so different from the broader experience in the economy, and unemployment being where it is, people hurting where are the healthcare crisis that we're going through. And I think my sense is it really does sort of bring to light something that's been talked about for a while, but it's really being magnified in this environment, is sort of the disconnect between prosperity on the one hand, sort of in the business world, and certainly in the financial and capital markets world. Not to say that there aren't pain points going on, but generally you'd have to say, sort of for asset holders, it's not been a particularly painful period. But if you look at sort of the broader economy and the broader population, it's been incredibly painful, and that seems to be ongoing. So that was something that struck me as we were preparing for this, and as I reflected on, how we were preparing for our annual meeting last week.
Great, and maybe I can ask Tracy and Lindsay, how have you yourselves and your firms, thought about, those inequities and that dislocation that we just heard about? Is that something that you and your partners are spending time on? And maybe Tracy can kick us off.
Yeah, sure. Absolutely. So I think this really has created an opportunity, this time period, for us to all reflect a bit more, right? And I think it was Kathleen Fontes who mentioned in an earlier panel from Grain that one of the positives that she sees during all of this is that, like, we as private equity investors really do have a lot of influence and the ability to make meaningful impact in a number of different ways. Obviously, with our, most importantly, kind of our investment dollars, but also I think with like the leadership positions that we can play in our communities, right? And certainly within the communities of our portfolio companies. And so we've had, a number of internal sessions to really talk about some of the macro issues, talk about what more we can do, engage more directly with some of the organizations that have been important to us really kind of over the course of our history as a firm. And I think, we can talk specifically about the issue of diversity and inclusion, but I think we'll probably get to that a little bit later, because we've created a couple of, specific initiatives that I think I'd love to talk about later.
Great. Lindsay?
Yeah, I guess what I'd add, I think Kian said it well, is given everything that's transpired and what's happened, it's been an opportunity for us to check ourselves. So the dislocation in the market and the economy has created challenges and opportunities for us as investors, as managers of businesses, as partners to our management teams, as leaders of our own firms. And I think it's given us an opportunity to take a step back and maybe rebalance priorities. And, all of a sudden we've had to really be faced with how we ensure, our teams, our portfolio and company employees are safe, healthy, that we're protecting them. While we've been able to sit at home and work safely, many of our employees have had to be, on site working together. So that's been one of the things that we've been spending a lot of time thinking about, ensuring how we're doing what's best for our employees always in a very changing environment. And then looking back at how we can help our communities, how can we play a bigger role, have a bigger impact? And then, of course, on as Tracy mentioned, with diversity and inclusion, what can we do different? What can we take away? How can we be leaders among our industry in changing things that we're all striving to see change?
Great, thank you. And I think sort of pivoting to the investment environment and how your portfolios are weathering the downturn, just for the benefit of the folks who are listening in. I mean, we have a really interesting group because represented on the panel, there are three very different strategies, right? With Cirrus as being kind of more of a value-oriented technology investor, in contrast with Insight, which is a little more growth-oriented, and then Crestview being kind of deep value, complex situations. So maybe just to get a contrast, to ask Kian and Lindsay, like, how have your active portfolio companies weathered the downturn? Are there any bright spots that you've seen during this contraction?
Yeah, I'd say surprisingly well. To be honest, we went into this in March with a lot of question marks and a lot of unknowns. And we had sort of given our companies assumptions to make and told them to manage cash under those assumptions. And in hindsight, those assumptions were actually too conservative, meaning things didn't end up being as bad as we saw. We had taken a step in Q1 of writing down the value of our portfolio by about 5%, and I remember doing an update call with our investors where we braced them for a more significant decline in Q2, sort of recognizing that we'd only had a few weeks of a COVID environment during March, during Q1. As it happens, it didn't turn out nearly as bad. Valuations adjusted significantly, so they went down at the end of March and they went up in April. So if you look at just sort of the underlying value of the portfolio and sort of marking to market, we ended up actually writing up the value of the portfolio by 18% in Q2, which was completely different to how we had guided our investors to expect. And we actually wrote up by another 26% in Q3. So it's been completely different. We were completely wrong. I'd rather be wrong on that side than the other side, but we were certainly completely wrong. That is not to say we have not had trouble spots. We do. And in fact, most of our companies are growing less this year than what they were planning. The good news is the retention of their existing customers has been very positive, and that's been great. I think the challenge for software companies is actually how do you get new customers at the moment if you're not able to get on the road, you're not able to go and actually visit them. But look, we have companies that are exposed to the restaurant space. It's a really, really tough year for their clients, and it's a tough year for them. We have companies that are very correlated with events and ticketing and things like that, and that's a very, very tough space to be in. But I'd say by and large, it's been good. I think some of it has been valuation driven. Clearly, in the software space, we're at pretty elevated valuation levels, and that is somewhat impacting our portfolio, which is not something that we can really control. We can't control public market valuations, but we can control our portfolio, and we can help our portfolio companies. And I would say by and large, if I separated it from the valuation impact and just look at the underlying performance of the companies, it's actually been very good. Most companies are growing, and some companies are growing faster than they were planning because they're net beneficiaries in this environment. But in general, companies are growing a bit less, but not nearly as bad as what we had feared.
We have had a similar experience. We've really seen the resiliency of our portfolio through this period. Certainly started in March with a lot of questions about what the future held. We were fortunate to have our portfolio pretty well positioned going in with low valuation levels, low leverage levels. We had been expecting some form of a recessionary environment. Never imagined that it would look like this, but had been conservative with leverage to allow our companies to play offense in a challenging market environment. And we've been able to execute that. Like Keon said, we saw some volatility with some markdowns in Q1, really driven by our public exposure, and then got essentially a full rebound in Q2. And we're just preparing to release our results for Q3, which will have another write-up. And so I think different than what we thought could be the case as we were predicting the future, being asked by our investors to predict the future back in March. We have one investment that's been particularly challenged from an operations perspective, an out-of-home entertainment business that does ferries to the national parks and has some overnight cruises. That's the one that really saw their operations come to a halt, but was fortunately in pretty good position from a balance sheet perspective and has been able to secure liquidity. The bright spots, the brightest spot has been an RV business that we own, a company called Camping World. Whereas, prior to March, it was a baby boomer recreational activity to buy an RV and tour the country. And then suddenly, after spending a few weeks at home, everybody across all demographics was looking to buy RVs and vacation in a socially distanced way this summer. So if any of you out there did that, I hope you were in a Camping World RV. It's been fun to see that trend really take off, and people you would have never thought getting in RVs and hitting the road have been doing so, and I think enjoying it. Insurance has been a bright spot. There's been some pretty material losses in the industry, which has driven pricing higher. And unfortunately, our companies have not had the exposure to those big losses, but are benefiting from increasing pricing. And our broadband businesses as well. certainly a lot of growing demand for broadband. That trend will continue.
Great. And as I think about asking my next question, I feel like I'm a limited partner running like a COVID update due diligence session with the three of you. So I'll apologize, but one of the questions that we did ask all of our managers when we were having update calls is how has this environment, both the economic contraction as well as the nature of the catalyst with the pandemic, either changed or impacted where you're deploying new capital? Like, are there sectors you're leaning more into? Are there secular trends you're paying more attention to? And are there areas you're avoiding? And I think our listeners would probably love to hear from all three of you. So maybe we'll sort of go Tracy, Kian, and Lindsay in that order.
Perfect. Yeah. Before I start, though, I have to say, I think even with the RVs, Lindsay, that some fundraisers are actually going the route of making investor rounds via RV. At least I've heard that to be the case. So yeah, look, I think with tech and telco, and this has certainly been mentioned, I think we had a number of themes that really have remained steadfast through this, but maybe perhaps it just accelerated a little bit. And some of those are going to be obvious to folks, right? Whether it's kind of unified communications and collaboration, which is something we've focused on for a number of years now. Certainly anything around security is an area that we're leaning into. Think about industrial IoT being yet another. And then there are, I think some themes maybe that have sort of re-emerged for us just because of the nature of change, right, in the way that we're working. And if we think about our investment themes, we really kind of have this framework, if you will, which is, okay, degree of change, right, from the pandemic and the way we're all working. And then on the other side, like the other axis, if you will, of the framework is pace of recovery, right, if there has been a negative impact. And so how do you play relative to that framework? And again, I think, some changes around the margin as a result of that. But I think, like most of our themes have remained, relatively intact. You have to clearly be mindful of end markets, right? I mean, we all know, and Lindsay and Kian have given examples, restaurant sector, event driven. I mean, our big issue in the portfolio is, directly tied to travel, right? But everything else, I think, has held relatively steady, or in many ways even, outperformed. I think the other thing I would say outside of the themes, just as we think about deployment generally, I think many of us, of course, were expecting a lot more pain, right? When this started from a financial market perspective, and that window of dislocation in the capital markets was pretty short. Needless to say, we wanted to make sure we were ready, right, to capitalize on that. And so we were looking sort of a little bit further up with respect to capital structure in terms of maybe unique opportunities to generate our PE-like returns in a slightly less riskier position in the cap structure. Now, we did a little bit there. And of course, since then, although notwithstanding today, markets have, generally recovered, again, surprising to many of us and not necessarily connected to reality. But so as a result, we're really kind of back to core platform, control buyout focus at this stage.
Yeah, thanks, David. I would say we spent probably sort of late March to early April sitting on our hands and sort of we're just nervous about deploying capital and really trying to see how the environment was going to play out. And actually, we're having a close on our main flagship fundraise at the time, and we thought, gee, our deployment here is going to be slower than probably what we normally have, which we would have been fine with. But to be honest, we started finding opportunities pretty quickly. Some of the things in our portfolio that I mentioned earlier that are actually growing quicker because of this environment are net beneficiaries, or areas like collaboration that Tracy just touched on. And so, I would say the hardest part for us, David, was we were finding companies that were growing faster in this environment, and the question was, how sustainable is this environment, and how long will that last? So we found a collaboration software company. Think of like an extremely elaborate version of Zoom. With all sorts of collaboration capabilities that could use for meetings, and they were, in Q1 they were going to do the revenue that they had done in the entirety of the year before, and in none of the prior years had they really grown that much. And it was sort of like, how do you process that, and can you play market multiples for something that might be in a very, very artificial environment and could, just as easily decline in a very significant way post this environment. So that was a really tough challenge for us. We did end up making some spaces that are broadly in collaboration where they were more vertical specific. So as an example of a company that we invested in was a company called TytoCare. It's an Israeli software company that enables physicians to do remote diagnostics. So it actually has a diagnostic device and a SaaS software package wrapped around it. We happened to be speaking to that company towards the end of last year. We're in a good position to help them raise capital, and clearly that's something that would have a positive tailwind. We did something else in the pharmaceutical vertical called Within 3, again collaborative, helping pharmaceutical firms run clinical trials faster. So overall, it's been actually pretty fertile ground. We've had to pick our battles. We have also investigated moving up the cap structure, so looked at preferred equity structures, where in certain subsectors of the software market where we kind of felt there was a lot of uncertainty, we could do more preferred equity type of investments.
Great, thank you. And in the time that we have, I'm going to fast forward us to the third topic we wanted to address, which is sort of the GP-LP relationship, and just circling back to our initial discussion about how the three firms on our panel have responded to the economic, social, and political dynamics and unrest in the country. We have the benefit of having three senior folks who not only have discussed with us their portfolios and value creation and where they see opportunities, but they also manage the other side of the house, which is the lifeblood of private equity, and that's the relationships with institutional investors like New York City and other limited partners. So it would be interesting to hear, and maybe we could start with Lindsay. How are your LPs responding to these dynamics, like in our country and in our society? What are you hearing from your institutional investors?
Yeah, I think there's sensitivity to this, and a growing desire after seeing everything unfold in front of us over the past few months to take action. I think this is all something that was important to the LP community, and we've come together at forums like this with RFK in particular and talked a lot about it. Certainly in our discussions with LPs, this has always been an important topic. But I'd say the degree of formality of information gathering and assessment to the GPs has varied quite a bit. Until more recently, and I think what's happened is as LPs have kind of sat back and watched this and said, okay, how can we make sure that our GPs are more accountable? And then how can we ensure that we're reporting that back to our beneficiaries? Money talks. And so I think there's been this move to take action, and the immediate response that we have seen at Crestview has been an increase in information gathering. It's interesting. I looked at the data from the questionnaires that we fill out on an annual basis. And last year, we had 5 requests for information that were specific to ESG or diversity inclusion. So standalone questionnaires or templates that were just tailored to those topics. I think that was sprinkled into many others, but in terms of standalone questionnaire, we had 5 last year. Year to date, we've had 12. I think the majority of those have been since June. So to me, that suggests that that's a direct response to what we've seen play out, and investors deciding that they're going to hold their GPs accountable, get the data, talk to them about what they're doing to make changes, and then revisit the data down the road. So we certainly appreciate that.
Great. And Tracy, what's been the experience at Cirrus when you speak to your investors? And I think we just have a couple of minutes left.
Yeah, I mean, not too much to add to Lindsay's comments. I mean, certainly seeing the uptick in the focus, and I think we should we're all looking at ourselves as firms, but also really getting down to measuring and building programs at the portco level. I think is an area of focus that's now more in sort of in light for GPs, but also for LPs as well. And I mean, David, maybe a good place to end would be great to hear from you directly. How are you guys thinking about this at New York City, diversity and inclusion in particular, in light of the macro situation? Has it evolved in the face of the pandemic and racial justice movement?
Yeah, look, I would say this, diversity and inclusion has always been a priority for New York City. It's part of our fund due diligence process. And, the GPs who are tuned in, they'll know that when you present to our 5 boards of trustees, you have to explain to us and to our boards, what are you doing about diversity and inclusion, at your firm and at your portfolio companies? And, we don't have targets and numbers in mind, but we want our managers to know that this is something that we care deeply about. And if we make a fund commitment and you're back in market for a potential re-up from New York City, and you're back in front of our boards, our trustees will hold you accountable, right? They will ask the GPs, you said to us that you were starting this initiative on gender diversity at your portfolio company boards. Where are you on that, right? So it's something that I think, the GPs in our portfolio know is a priority for us. And I think, I remember participating in an RFK event in the spring, and the way I personally have been thinking about it is it's intellectually and almost morally inconsistent for us to look at what's happening in our country and our societies with one lens, and then go buy portfolio companies and make fund commitments using a different lens. And I think that's something that I'm sort of trying to figure out, like, exactly how can we better implement that consistency of how we look at the world and how we look at our lives professionally. And I don't know whether we have. I'm gonna try to squeeze in like 3 quick rapid fire questions, and we'll go Tracy, Kian, and Lindsay. Just to wrap things up, what % of the private equity industry do you guys think recognizes the importance of diversity as a value driver today? So Tracy, kick us off.
Recognize 75, act 30.
Kian?
I'll say recognize 50, act 25.
I'd say I'm in line with Kian. 50 recognize, act 25, but growing quickly thanks to the shakeup that they're getting from the LPs, or in heightened focus on all of this.
And actually, on Lindsay's point, who do you think will be the driver of change, the GPs or the LPs?
LPs.
LPs are starting it, but GPs have to step up and they make the change happen. I think everybody needs to come together and make this change happen, and that's what we're all here for.
And Kian, your view on LPs or GPs being the driver?
Look, it has to be both, but I don't think much changes without LPs really using the stick. I really think that's what makes it happen. I think GPs just get stuck in their business as usual. They just have to be forced.
And then finally, do you expect 2021 to be better than 2020?
Yes, better.
It has to, right? I mean, we're all counting down to New Year's Eve.
I can't wait to get on the plane.
All right. Well, on that optimistic note, let us turn things back over.